you have to understand what your relationship with money is, and you have to bring that to your financial planner.
What's my relationship with money, Gino?
Bro, you don't like to lose money. You hate losing money more than making it. So that's very interesting, right? So you have the pot there. So you're saying, well, if I get rid of my money, I'm going to lose money from this pot, and I
don't want to lose. I want to make it, and I don't want to lose it. Hello, everybody. It's Jake Sensei, host of Jake and Gino Podcast. Here with my co-host, the multifamily mentor, the coach, chef, the father of six, the best-selling author, the G-Daddy, Gino Barber. Gino, how's it going?
Doing good, brother. How you doing this morning?
Always making it happen, big man. Got a special guest today. Today's guest is the founder and CEO of Retire.us, a fintech platform disrupting today's financial services industry by making premium financial guidance frictionless and affordable for everybody, including you, Gino, even those people in Florida. So, without further ado, Michael Scarpati, welcome to the show.
Hey, what's going on, gentlemen? Thanks for having me.
Hey, it is our pleasure. Maybe just give us a little background on yourself and how you started the organization.
Sure. So, Philly guy, born and raised in the Northeast, and always been an entrepreneur at heart. Have a family of various entrepreneurs, and jumped into the financial services industry right out of college in this entrepreneurial, independent fiduciary financial planner track, which is a very
you're gonna have to unpack
flavor.
that, because that's just a lot of hogwash to me. I don't even know what you're saying right now, dude.
All right, let's unpack it. So in the financial services industry, this is kind of the first big thing that most people are super unaware of. All financial advisors, all financial planners are not created equal. So there's different types that you can work with. Most of them, 80-90% of the financial professionals are not independent, and they're not fiduciary, meaning they're not independent. They work for an institution. So when you go to hire them, they don't work for you. They work for another company.
It's like going to Supercuts, and they're working for Supercuts, and they're pushing the Supercuts haircut. Whereas I go to my barber, he cuts me tight, all right? And it's his own thing, all right? That's his signature cut, bro.
This sounds even worse. This sounds like a doctor's office who's working for Pfizer to sell some vax shots. They're not really independent. They are, but they're sort of not, because they're getting based, and their bonuses are based on doing the vax thing. So that's what this sounds like, as far as they're trying to sell you products that may not fit your life or may not
Fisher Investments.
Fisher's actually one of the few that operates in an independent fiduciary scope. So they're actually one of the few, but Fisher's Investments is a great example, because
I just see their ads everywhere. So I'm like, man, what are these guys up to? Right.
In order to work with Fisher, though, you need $500,000 or $1 million, right? So to have that,
Gino's out.
to have that independent fiduciary is the other word. Right? Fiduciary means they have to give investment advice that's in your best interest. So imagine.
Wait a minute. I got to understand this independent piece, because so obviously you're going to have a company, you're going to have people working for you, right?
Yep.
We're not talking about that, are we?
No, it's more in terms of how you're structured from the product side of things. So Gino kind of hit the nail on the head, which is, if you're independent, you have what's called an open architecture when it comes to product. So you're not
selling your own stocks. Is that it?
You're not selling your own stocks or the company that you represent. Most financial professionals can only make recommendations in the ecosystem in which they operate, right?
Yeah.
Which is,
here's our package,
big institution. Yeah, you go get an advisor there. Exactly, right? Most of these companies are mutual fund companies, and all roads are going to lead to their products. Now, that's not to say that their products aren't great. Plenty of them have great products, but the thing is,
but I get you, right?
It's not, they're not great at everything, right? They're not great at everything. And when you're independent, working with an independent, you can build the all-star team, right? You can get the, Team USA basketball versus, pick your team. There's still some great players, but is never going to go to compete with
It's like Team USA versus a WNBA, man. They're just dominating, right?
It's Team USA versus hopefully anybody, as long as we can continue the streak that we've been on for the past, majority of the years. And that's kind of the big elephant in the room that most people aren't even aware of. So they go and they seek advice from somebody that, first of all, is limited typically in what they can offer. And then the second part of that word salad I gave you, which was independent fiduciary. Fiduciary, this goes actually more to what you were saying, Gino, which is, that means operating your best interest. So only about 15% of licensed financial professionals have a legal obligation to give you advice that is absolutely in the eyes of the law in your best interest, right? And so it's exactly like
because the other guys are self-serving essentially.
Yeah, and it's just that they don't operate in a world where they actually can, right? They can't make that case generally because of their limitations and because they're not contracted by you. They don't work for Jake. They don't work for Gino.
What's the
They work
legal
for an institution.
difference, of being the fiduciary or not?
Legal
On
difference is
paper,
someone-
what does it look like?
on paper, it's essentially there's an agreement, there's a contract that
In the
independent
agreement,
fiduciary-
it says,
yeah, that if you don't believe this is in your best interest, you take me to an arbitrator, and like my licenses could be on the line. I could be subject to a lot of fines if I'm a licensed financial professional saying we're operating as a fiduciary. There's accountability associated with the advice that's being given, and it's wild. Think about it. So about 85%.
So if you act in a way
doesn't have
that's clearly against the financial success of your customer, you could be held liable.
yeah, and it's
That's the way it all should be, though.
100%. So the industry is structured in a way so that Fisher Investment is a great example, right? Independent fiduciary, you can go work with them, but you need $500,000, $1 million for them to take a meeting with you.
I gotcha.
So what about the person that has $100,000, $250,000? They're not worthy of independent fiduciary advice. Like that's bullshit. That doesn't make any sense, right? So, but that is the way that the industry really works right now. The platform that we built is meant to open up that access. No asset minimums, no high flat retainer fees, basic easy subscription model. You get access to these independent fiduciaries without the barriers in the way.
When you're looking for that financial advisor, financial planner, what are you looking for? What kind of qualities do you want in that individual who's going to help you manage your money, manage your assets, manage your whole life, manage your insurance, manage your base, not just your portfolio, but it has to come from a holistic standpoint. And I think most people don't understand that. You want to limit your downside risk. It's great. What's the deal going to make me? But how am I going to recover if I lose the money, or do I have enough reserves? Does that make sense? Because I think most people misunderstand what a financial advisor or a financial planner actually is supposed to do.
Yeah, it's such an astute point, because most people associate the term even financial planner with portfolio manager, investment advisor, when there's actually a major difference between a financial planner and an investment advisor or a financial advisor. They actually operate in two totally different worlds. There's crossover, but the planner is really where you should start. So the guidance is you want to start with somebody that's building holistic plans and systems, right? I don't know if you've ever heard of the book Atomic Habits by
Yes.
James
Oh,
Clear.
yeah.
You guys ever heard of that?
Yes.
So he has a quote in that, which is, we don't rise to the level of our goals, we fall to the level of our systems. Your finances work the same way. The problem is most people start with product, right? Which is chasing specific goals. And there's no real system in place for a lot of what you just mentioned, right? What happens if the market does fall out? What happens if tax laws change? What happens if all of a sudden there's a big thing in our life that requires us to dip into our cash reserves? The systems, putting systems in place first, a real plan of how we're actually making financial decisions first, how those variables actually all work together, and then filling that system with products is the optimal way to approach it. But because of the way the industry is structured, guess what? Most financial professionals represent an institution that's in the business of product. So most people start there.
But would you say you're almost as if you're a natural doctor? You're not just trying to, give you a pill, make you feel better. Well, let's see what the cause is. Why are you hemorrhaging money? Or are you protected here and not protected there? You want to look at the person holistically, because everyone in this world is unique, has their own specific set of goals. Jake wants to own thousands of multifamily apartments. John over here may just want to have his W-2 job. They're different goals, different protections, all different types of risk profiles. Shouldn't the planner be involved in that as well?
Yeah, that's a great analogy, because most of the professionals are approaching it from that non-holistic perspective. And they may take a little bit of a holistic approach in understanding what those different facets of your life will be, but then the guidance actually is just still a product, right?
Mm-hmm.
It's still this investment or that investment, when there's so many other facets that we do need to consider, right? How does our cash flow impact the trajectory that we're on, right? That right there changes. If you're saving $10,000, $15,000 a year, that's going to dramatically change actually the risk profile itself, even of the the portfolio you have. What about if it's a tax deferred count versus a tax free count, right? What if there's ways to shelter your taxes when you're quantifying your retirement goals? If that's being quantified in a pre-tax position, right? IRA, 401k versus Roth, tax free, those are going to end in different numbers that you need to have saved. And so you really want to start with the end goal in mind, but then build those mathematical frameworks, right? And those models to then understand, okay, now that we have all this information, we have a very clear roadmap and we have purpose, right? That purpose, that intent should then flow through the product architecture of really, okay, now that we know we need this type of investment, and it's not about my risk tolerance, right? That your risk tolerance is how you feel. It's about your risk capacity, right? What is the amount of risk you can take? How much can you lose without being knocked off track? Not just the part where you're like not able to sleep at night. Like that's important too. But all those things a lot of times are really missed when we lead with the product. And there's two types of fiduciaries, and that's the thing. Most people there's a planning fiduciary. They don't manage money at all, but they charge 5 to 10 grand a year, like an attorney, just to build those systems, to build those frameworks. And then there's product fiduciaries. Now they don't charge a flat fee up front, but they charge you on your assets, and you need $500,000 generally minimum, closer to $1 million a lot of times, in order to have access to that. What you really want is both, right? Like that's the key. And that's the unique thing that we're creating with the platform is two types of financial professionals, both fiduciary, both wearing different hats that you can work with essentially simultaneously in this team environment in a very frictionless, easy, human way online from anywhere in the world.
It sounds like a manager versus an agent almost.
Yeah, from a good sport. That's a good sports analogy. And like the layman would never know the difference between those two things, right? Truly, like if you're not familiar with, the entertainment industry or sports industry, you might think those are the same thing. That's what we find 95% of the time with the general consumer public is that this nuanced difference makes a gigantic impact in our approach to our finances, but most people merge it together as financial professional, right? Financial advisor as one thing, and they serve different purposes.
The thing about retirement that scares me is that once the money stops coming in, you're burning off the pile, except for interest income. And that's the thing that I hate about traditional retirement, because to live a abundant life, you need to save up so much money to make fixed income work. So that's the thing that I've had a hard time buying into, the saving up of the money, letting it burn down. And that's why for Gino and myself, we own a business that's somewhat passive. It's not really, it's active, but you can do it and scale it out where I feel like you could retire and still own the apartment complexes and manage them through your team. So that's been our route. What is your sort of volley back to that, and where am I missing, or where I maybe potentially short-sighted?
Jake, I want to put a bookmark on what you said. People don't have a net worth problem when they retire. They have a cash flow problem.
Yes, that's what scares me. Like once the money stops coming in, you're effed in my mind.
I'm just trying to simplify what you said into a nice, easy way for Michael to understand and digest. Thank you, Michael. Take it away, brother.
Yeah, well, so two different things can be true and right simultaneously, right? The nuance is what makes the difference. And so you're right. And the path that you guys are going down with the multifamilies is an incredible, great, lucrative, and like very stable path. The reality though is it's not the path of least resistance, which is what the vast majority of the general American public requires, right? So your path is great, and you're going to get way more leverage on the money at the end of the day. Like you're going to get way more leverage on the amount of money that you've put into these assets and the cash flow, undoubtedly. Like it is a great, incredible path. It's a path that I've also chosen to go down as a portion of the way that I structure my own investment strategies. However, it requires effort. It requires understanding in that area. And it's too much effort and too much understanding required for the bulk of the average American consumer. And so because of that, they tend to be in this path, which you're right, requires a lot more savings in order to make it happen. Now, there is a crossover point. There is an inflection point that does happen based off of your net worth. generally you've probably heard the 4% rule.
Tell me what it is. I probably
withdrawals.
have, but I forget most things I hear.
It's basically saying 4% is the optimal amount that you can withdraw without running the risk of running out of money. So if you have $1 million saved,
It's such like
40,000, right, is what you would take each year. But that's the optimal number because you're really not at a spend down at that point. Historically, if you're just in a very simple like 50-50 portfolio, that percentage, your portfolio will continue to grow over time.
I just hate the limitedness that's associated with that, right? Like,
Yeah.
we can give you, here's your ration for the week,
Yeah,
but there's not going to be anything more than that.
That's really how it and that's the way it has to work, though. That is very true. It's a ration approach. Now, it does not, as long as you've structured it correctly and you do understand those numbers, though, it's not like a burning fuse, like,
You're burning off the top. You're taking off the top, right?
Or, when the market's down, then this is where we go back to systems. If you have a true system in place, you have buckets of money that even if the stock market crashes, you're not going to lose anything in that bucket of money. But if the stock market continues to improve and go up, you're still going to be participating in those gains. And so, the full market money, when that drops, you can touch the money that actually is safe, right? When the market comes back up, you go back over to the market money because you're able to take the interest and you're able to kind of play, we call it the sequence of returns, managing the sequence of returns to, ration those withdrawals in a proper way that doesn't run the risk of exhausting them.
Even the word rations interests me. But I've thought about like, okay, so if we sold our portfolio, how much would I need to make in like a fixed, government bond or something type scenario, and then I could use that money. But even in that, like, I'm going to get twisted up and pissed because I know, right, if it goes beyond that, and then I'm going to, I want to save more, and my life is going to get like accelerated. The misery of my life is going to accelerate, and I'm going to be a miserable prick the more and more because I know I got this money and I can spend this, but I want that to grow. So, but if I'm working, I'd rather have the pain of working and doing the work to make sure there's more revenue coming in and the whole thing is building than managing this limited pot that's, I don't know. It's just a personal thing, right? Where it would mess with my head.
Well, you're an outlier. Like you're an outlier of most people are creatures of comfort and creatures of habit. And so their lifestyle.
That would be uncomfortable for me though. Like that would be uncomfortable managing the pot to zero or something like that. But Gino's going to punch me in the gut. Go ahead.
Well, Michael, I got to talk to Jake for a second. I need to coach him on the call right now. What he's failing to understand is that's his relationship with money. I just became a money coach, and he's good. He understands the pain, and he understands his.
I understand if it stops
money.
Coming in, you're screwed.
Well,
right?
For you it does, but for others, like Michael said, others have different goals. Others don't want to be managing something. Others just want to be able to go to work.
Gino just joined the fire crew.
I'm not joining any crew. He's gonna be
in a camper down by the beach burning wood.
I'm trying to elucidate the topic of you have to understand what your relationship with money is, and you have to bring that to your financial planner.
What's my relationship with money, Gino?
Bro, you don't like to lose money. You hate losing money more than making it. So that's very interesting, right? So you have the pot there. So you're saying, well, if I get rid of my money, I'm going to lose money from this pot, and I
don't want to lose. I want to make it, and I don't want to lose it. I think.
Okay, so that's even worse. It's a double whammy. So. But what's really great about your profile when you're an investor, you are very diligent. You're looking at an asset. You're saying, I hate losing money, right? I'm really tight with the expenses. I want to increase income. So that's your relationship with money. You're understanding, okay, these investments work really well with me. Multifamily, I can control it. I can grow it. It's all about me. I'm not going to invest in stocks because Apple's going to say something stupid and lose 30%. I don't have control on that. So anybody listening to this, when you're doing your risk profile and your relationship with money, don't listen to somebody and listen to them by saying, well, multifamily is the best vehicle. I'm going to tell you honestly, it is one of the best vehicles. My net worth has exploded. None other than the inflation and whatever. That's the vehicle. But it comes with a lot of difficulty. It comes with sleepless
It's very difficult
nights.
and painful.
So I'm just saying, and you know what? You don't have to start big. You can start small, but understanding that relationship you have with money, understanding what your goals are, understanding what your vision looks like, you can extrapolate it out 30 years and bring it back to today and say, well, you know what? I want to grow my money. I want to learn. I need to learn, but I need to know what's going to keep me up at night. Is it worth sleepless nights for the next 5 years just by getting into multifamily and maybe doing well? Or, you know what, I'm pulling that money back and saving it and understanding that Jake, to me is really important. And you know what makes you happy. And you're not going to just put money in a pot and just take 4% out. That's great. You already know that. That's not what makes you happy. And that's not what's going to light you up. And you're not going to do well in that vehicle. So understanding the vehicle, I think, is important. Michael, I don't know if you want to add to that.
I have actually a question for you guys. So in multifamily, what's the yield that you guys are targeting on the property? So
Great question.
In terms of cash flow based off of asset value.
So from a underwriting perspective, it's a minimum of 7% cash on cash return minimum, right? And that's stabilized, fully amortizing, no bullshit, right? Kind of thing where it's like some people write these stupid, this is just a base stabilization of what the market rent is. We need minimum 7% cash on cash return. But what we actually look at is what we call PPU, and that is profit per unit. And so we have a draw report that we do on the first of every month based on the actual cash bank statements that come out. There's a baseline income, expense, prior month draw taken out of that. So you see actually what your net cash expense is. And then you have your baseline. Say your baseline is $75,000, meaning you keep a minimum of $75,000 in the account. Here comes the first, and you have $100,000 in the account. You draw $25,000 out. Okay. And then we divide that by the number of units. And that gives us our PPU, or profit per unit. So what we're actually looking as we go through our portfolio, we got about 1,900 units. We're looking at where the PPU is the highest. And then we're saying, okay, is it in the 2 bedrooms? Is it in the ones? Is it in this location? Like, what are the amenities that are driving this? And then we look for more of that to try to structure the portfolio based on where the market is going. I think, phenomenal, really good is anything over 500, sub 200 is, not what you're looking for necessarily, right? So if that helps.
To elaborate on what Jake is saying, we're a little unique because we don't syndicate deals, so it's our equity as well as that. So we got rid of the whole syndication route after our 3rd syndication. We just didn't like that route. We were vertically integrated. We couldn't outgrow our infrastructure. So to feed the investors, it was very hard. We couldn't find really deals that were profitable for us. And the profit per unit is really, really important for us because that's the profitability. And what's really interesting, most people won't tell you this, but investing in multifamily is like investing in a business. It's income over expenses. So you're not only getting an investment, you're not only getting cost segregation, you're not only getting cash flow, you're not only getting principal pay down, you're getting scalability, and you're getting a future stream of revenue that you can monetize today. And then in the future, you can package that up. And if you'd like, you can refinance out the proceeds, or you can trade it up and sell. So there's multiple areas, and even possibly 5 or 10 years from now, sell it on a seller finance note. So there's so many different options and exit strategies, and not one size fits all, because people have different skill sets, different goals, different equity, different balance sheets, different skills. And a lot of times people don't view it as a business. And that's the biggest mistake. It's great to be profitable, but understand that you're buying something that has to be managed, whether it's from you or a third-party property management company, and you are the asset manager. Just as if you're managing a stock portfolio, you're going to manage the manager.
Just a lot more hands-on, right?
Yes.
Yeah. Are you guys doing any DSTs or OZs? No, okay. All mainly traditional. The interesting thing, because one of the things to kind of go back to you, Jake, is a way that sometimes. So you're saying, just to make numbers very simple, I have $1 million invested in multifamily property. I'm expecting $70,000 in cash flow from that property now, but there's going to also be some level of expense on that, or is that net?
Net.
Net. Yeah, so that,
and then if you get, the, what do they call it? The big beautiful bill. What do they call it? There's there's like a term. There's like an acronym or something they call it. I forget what the hell they call it. But anyway, so there's 100% bonus depreciation, right? So the interesting thing is, say you do that every year. Say you reinvest $1 million every year, you get 100% bonus depreciation. You may actually be able to keep that 70. Jim. So it's a real 70. It's not like 70 less 37%.
Yeah.
But you got to keep going, right? You got, and that's the thing. You got to reinvest it. It's not like I'm going to take it and go buy the Ferrari and all this on day one kind of thing, right?
Yep. But during that entire time, right, you're not paying attention to. You don't care necessarily what the value, the underlying value of the property.
Sure, I do.
Yeah.
Right? Because think about this. I'm going to get preferred debt the lower my loan to value is, right? So if I take
Right,
it,
sure.
so we do 10-year terms, non-recourse Fannie deals typically. So in 10 years when that deal is up, right, I want the value to be the highest it can be, because say I do 65% LTV versus 80% LTV on the refi,
Mhm.
my spread is going to be the best that it can be on that deal, because that's less risk for the bank.
Yeah, no,
Right.
which makes sense for
And
sure.
that's a big deal, because then I can
Yeah.
still probably refi some money out tax-free, right? So that money's coming out tax-free, and I'm getting the best debt that's out there, because my property's humming along at a nice clip, right? So I think it definitely matters. Otherwise, you're just going to be paying more, and who wants to pay more,
But
right?
Michael, to your point, the only two times you really care about the value of your real estate is when you buy it and when you either sell or refinance it.
Right.
Those are really the only two times. In between, it's really one of those things where it's like a net worth kind of thing. And hey, I'm worth 120 million. So it doesn't really matter, but it does matter when you're out there having to buy the property, because you don't want to overpay, and it's
Sure.
time to sell. You want to maximize your obviously your profitability.
Let me say
or
one thing to
refinance.
that though, Gino, because
Talk to
higher
me, baby.
value, unless it's, a market situation, cap rates are up or down, in my mind is equal to property performance, right? So
Yes, great
the
point.
higher the value, the better. That means your property's performing better. That means your cash flowing better on the property, unless whatever, something changed in the market and cap rates have gone up or something like that, right?
But what about what if there's a 2008 scenario then? So what if it goes in the opposite direction for valuations, right? When we
So
saw
we're
this
okay.
big
Hold
valuation
on, let him
change.
finish. I just want to be specific.
Yeah, so like I guess my point is like that's not going to necessarily impact the cash flow, right? Unless of course somebody can't
Well,
pay
if
rent.
vacancy, no, but it can though, because if vacancy dips, right, you're going to have less cash flow because you're going to have more vacant units, right? So you definitely, there's market fluctuations for sure. I think that's the key when you're buying these things, and where people messed up maybe in '08 and 2022 is that they went out and bought a C-class apartment in 2022 at a 5 cap,
Mhm.
and they underwrote 20% year over year rent growth. And now all of a sudden they hit 23, it flatlined.
Yeah.
They're not hitting it. And so they're doing workouts with the bank, and they have this older asset that, they maybe not managing well, et cetera. That's where it gets weird.
Michael,
Yeah.
but
So you got
the
to buy
point,
right.
yeah, but the point that you're making is in 2008, people had properties that were cash flowing, and they cash flowed into foreclosure because asset prices dropped. But what the difference between residential and commercial is, in commercial, you typically have terms that are not 30-year amortizations, right? They're basically 5-year terms, 7-year terms. So if your term comes due in a downturn like it has over the last 18 months or back in '08 and '09, all of a sudden the values are dropped below. You can't sell the asset for what you need to sell it to cover the debt, or you can't
Right.
refinance it. That's where the risk comes in to understanding this. So you have to manage your debt when you're buying multifamily as well. It's not one of those things where you just lock it in and it's gone. We're very fortunate that the next asset we have coming due is in August of next year. So all of our debt is fixed, and we decided to do that. We did 10-year terms on a lot of our assets back in 18 and 19, and we understood that let's lock it in. Our valuations are up now, and I think that's where a lot of people have made mistakes in the multifamily market and in the commercial market, not understanding the risk of debt.
And that deal Gino's talking about as well, the debt on it right now is not great because we bought it in 22. So we're actually, when it resets, we're probably going to save 2 points on it, which is huge.
Yeah.
22, those interest rates were spiked crazy.
Yeah.
Yeah, well, and thank you for sharing all that with me, because it helps, I think, paint the picture of why most Americans do not go down this route, because
it's a lot of work.
complicated. It's a lot of work, and there's a lot of nuance to it. Most of the investing public would look at, perspective-wise, they would look at a dividend fund very similar to a multifamily or a rental unit. In that,
What's the dividend? What are you getting? 4% maybe?
So it depends. It depends on the note or the type of investment. There's things like structured notes that could be given dividends back when interest rates were higher. We saw these dividends in 10, 11, 12% range.
How long are they guaranteed for?
Generally, those types of notes are usually, you see them callable in a year is traditional. And the notes themselves will be anywhere from 3 to 5 years.
Are you buying companies with these, or
those more higher yield income notes, they would call them, are generally, it's institutional debt, actually. So it's balance sheet money from Bank of America. It's ways that they're transferring risk around their balance sheet, and they're tying some underlying investment index generally to a debt instrument. So they'll say, all right, we're going to tie, you give me $1 million, we're going to say, we'll give you 7% per year, 8%, 10%.
Is that guaranteed?
You can't use the word, you can't use the word guarantee in the investment and security space. It's backed as good as the financial strength is of the issuer. So it's as good as Bank of America.
If Bank of America doesn't fold, you're getting paid at the end of the year.
You're gonna get your dividend. But then what
is there any risk to the underlying principal?
They can all be structured different ways. That a lot of times that risk will be tied to the underlier. So if it's a pure income note, what we're talking about is an income note with an institution like a bank, like Goldman Sachs, Bank of America. And generally there'll be an underlying index that they'll track, and then they'll create what's called a barrier at the bottom on the downside of it. So they'll say, we're going to pay you 10%, let's say. You're going to be tracking maybe a more risky index like the Russell 2000 or something along those lines. Now, as long as and we're going to say it's the term for this deal is 5 years, right? Those are the terms. Now, as long you have a barrier of 40%, which means if the Russell ever drops below 40%, right, our payment may be contingent upon that barrier. So
40% of the current value.
Current value when you initiate the trade, or when you initiate the trade. So this would be like a contingent income play. So as long as that index is never down below 40%, you're clipping your coupon. Now, a lot of them will be callable in year one. What does that mean? That means that if the index is up at all after the first year, the bank's going to give you that first year of interest, and they say, okay, we want, we're resetting the table. We can maybe do a new deal, different interest rate. If the index is down after that first year, generally then it's going to hold for whatever the duration is of the term. Now, the risk comes in at the time of maturity. If the Russell is down over 40% at time of maturity, that's where your risk comes in. You are now taking the risk of the equity itself, of the underlier itself. But, odds are most of the time over a 4-year trajectory or a 5-year trajectory from point to point for an asset class like that to be actually down 40% over that time period, it's highly.
So when you cash
possible.
out, you're tied to the present value of the Russell.
When you cash out,
so at the end of the 5 years, like if it was 100 and it's down to 80, you're getting 80 out essentially. Right?
No, so that's the thing. As long as you're within the barrier, you get your principal back. As long as you're within the barrier, you get your principal back.
That seems like a pretty sweet deal. I think. What do you're in the green? 90% of the time on something like that?
I can't speak to it, but I'd
love to know.
I guess as good as mine, but but these are types. What I'm explaining to you though, these are types of investments that open architecture, independent fiduciary product managers work with, right?
Yeah. No,
this is not things like that most
that's
people.
Interesting, right?
Right. Yeah, of course. It's unique, and they're all chess pieces that you can put on the board.
If you hang in longer and it's down, and you say you ride out longer, or do you have the optionality to do that at the end of 5 years?
You
to stick in there to preserve your principal if it's below 40%.
Once the term is up, they're looking at what happened. Once your term is up. Yeah, once your term is up, they're looking at what happened. So you have to be very strategic with the notes that you use. And so these types of products, right? Most people have never heard of anything like this.
Yeah, I don't know about it.
Because this is the ecosystem that generally requires $500,000, $1 million net worth minimums to investable to just open these doors of access. So there's all these interesting things that you can do that can mimic things like multifamily, but with different risks, right? There's still risks associated with it for sure. Right? Multifamily's more than likely doesn't have the potential to lose, if you just cross that barrier.
Just depends, what you pay, right? It's all about, it just depends what you pay and your knowledge of the asset going into it. That's where the risk is. Yeah.
So we went down a little bit more of a complicated path there, but for the simple path, just a general dividend paying fund, just like a general dividend paying mutual fund could be a basket of a handful of different stocks, or it could be a bunch of different bonds that are in one pool of money that are just going to pay 4, 5, 6%. Now, that dividend is pretty stable. So just like your cash flows, like you're running at 100% occupancy. And the value, though, is going to change based off of market movement, just like the housing market's going to change. The difference is, regardless of what happens, markets appreciate, markets depreciate, the occupancy level is 100%. And so, and people don't have to do anything for that, right? Like they just sit back and relax and clip their
like
file.
What, like 4%, 5%? That's where we're going to end up.
Yeah, I mean,
we're going to end up with Michael in some kind of like snoozer pond, right?
It's all relative based off the interest rate environment, just like it is in some of these other markets, right? When interest rates are higher, those yields are higher. When interest rates go down, those yields generally drop too. And it's all dependent, right? In that situation, we're talking about debt. If you're talking about, other dividend paying stocks, that's up for debate too, depending on the financial strength of the company. But you can kind of make the correlations of how people try to recreate a similar field, just with a lot of path of least resistance is just kind of the explanation.
Cool. Gino, anything else before the short answer?
Nope.
Okay, let's take a quick time out here from our sponsor.
What kind of legacy are you building for your family? It's not just about money. It's about making sure your values, your love, and your intentions live on through the generations. Happy Money, Happy Family, Happy Legacy is your guide to creating lasting financial security with purpose. From living trusts to children's needs trusts and special needs trusts, we break it all down in simple, family-first language. Learn how to have the conversation right now with your family. Don't wait until it's too late. Protect what matters most and create a legacy that future generations will thank you for. Download your copy today at Barbaro 360. The link is in the description.
All right, we are back. So, we got a feel for, you're open to work with anybody. There's no minimums. Where do folks start with you?
So just go to retire.us, retire.us. We are a fintech platform that connects you with these independent fiduciaries and makes it basically as frictionless and easy as possible. Most people don't get started because they fear the heavy lift and they fear, the time required to vet and find people that they can trust. And so we're here to essentially make that seamless and easy for you and open up those doors of access. So retire.us, also on socials at retire.us. You can find us as well, pushing out a lot of content to just help you raise your financial consciousness and get yourself prepared.
All right, give us some money or investing advice that people are missing. So, we didn't, if we don't have the 250, we're not getting in with the big boys and things like that. What is something glaring to you that the average citizen is missing on investing or retirement?
I'll take it to a little bit of a different path where I don't think it's about the investments themselves. I think it's actually about understanding tax consequences with the investments and where you save your money. So most people end up putting a lot of money in tax-deferred retirement positions, traditional 401k, IRA, and what they do not realize is that at 72, the IRS is going to make them take withdrawals and pay income tax on it.
The Reaper's coming for you.
The Reaper's coming, and it's called required minimum distributions. And they start at now 73 is going to be the new age. But the reality is that percentage increases every single year, and it pushes people into higher and higher and higher tax brackets.
That's a tax payment strategy for the IRS.
It's the best long con that's ever been played in the history of America. Honestly,
I've been saying
really
that. They create the demand within 70s pension deferred benefits contributions back in the 70s, and they start the 401k, and they're like, well, we want you to put money here because you're going to create demand in the stock market. And then when you're 70, even if you don't want to sell, we're going to create supply because you got to sell. And oh, by the way, that money you've been saving, we're going to take 30 to 40 cents on the dollar when you sell. So if you look at it from that perspective, it is the biggest scam perpetuated ever. I'm I'm so annoyed at the whole system, and people don't realize that it's really, I mean, not a great system. And then they go and bash my lovely whole life insurance. When you have money growing in a whole life, that's a non-correlated asset. You've been doing it for 30 years. You've got a death benefit. You've got all these protections. You've got guaranteed growth. You can start borrowing from the cash value. You're not going to have any or a much less tax situation. And my whole point to this whole rambling on is, don't listen to somebody and say, this vehicle is good, this vehicle is not good. You have to understand what your goals are and how you're trying to use these vehicles.
Yeah, the big picture is the thing that most people are missing, right? There's a lot of ways that these things overlap. And I'll take it one step further. Compare your whole life to the required minimum distributions and the qualified accounts.
Mm-hmm.
Once those qualified accounts have to be inherited down to the next generation. The Secure Act says now those required minimum distributions can't be stretched across the inheritance lifetime. You have to take withdrawals in 10 years, pay taxes. So somebody inherits $10 million in a qualified asset. Guess what? They have to take essentially a minimum of $1 million in income per year.
What's a qualified asset? What's the definition of a qualified
IRA,
asset?
401k.
Gotcha.
Yeah, pre-tax money when it went in, it's going to be income tax levels when it comes out.
Wow.
But the Secure Act, this happened right around COVID. They passed this law which says if you inherit a qualified asset that is in required minimum distribution phase, it's in that phase where you have to take the forced withdrawals. You have to withdraw the money over a 10-year period and pay income tax.
Why would they force you to do that?
I don't know.
So this is the flip side, guys.
That's the multi-trillion-dollar question.
Yeah, that's a tough one to solve, right? So here's the thing, just for everyone here. Gino walks around daily with a pitchfork. He's got a straw hat on and a tumbleweed sticking out of his mouth. He's out on the farm cooking up the organic vegetables. His wife's the doctor, and all his real estate is where his money is, or it's under the mattress. So it's a little bit of different scenario, folks. It's a harder life, but there's benefits there. So it's more than just the money here. So Mike, I had to give you a little background on Gino there because
I'm the Italian redneck. You're the organic hippie. Okay, let's get that straight. Okay, I'm the Italian redneck. I'm driving around the tractor. I've got the donkeys, a couple of cows out there. I've got the 30 chickens.
he
I got
fuels
the honey
it
going
with
on.
Canola oil too, right? he's got it running bubbles out the back. Oh man. So all right, you mentioned Atomic Habits. Any other book recommendations that you want to throw out to the audience before we wrap up?
I would start there. I mean, that I think is such a profound book and understanding, starting to become conscious. Financial consciousness is a big part of this process. And, we today, hopefully just some of the topics that we chatted about raise some people's awareness of, I didn't even know that was a thing. Most people don't know what they don't know. The habits.
I learned a lot, and I appreciate it, man. You definitely opened my eyes up to some things. So
thanks, man. Yeah, I mean, most people don't know what they don't know, and I think that's the same for themselves too, right? We don't know what even drives us, and as Gino's talking about, coaching money, the relationship with money. If we don't understand the relationship with ourselves, especially with our relationship with the habits in which we spend money or save money and how that day-to-day operates, it's really impossible to kind of get to the next level. So I think that's a good place to start. If you haven't read that book, that's definitely one that will wake you up a little bit more to how human behavior really dictates your future and the version of yourself.
All right, the Italian redneck, take us home.
I'm going to recommend another book by Morgan Housel, The Psychology of Money. I think that was very important. He's written a couple other ones, but that one initially got me down the path of understanding my relationship with money. And as you're listening to this, going to retire.us, it's a great platform. Just start looking out. And what I love it's Mark Twain's quote, "It's not what you don't know that's going to get you into trouble. It's what you know for sure that just ain't so." Ooh. And that's the truth. Most of us think we don't know this, but we know this for sure. Like we think this vehicle is going to help us out. But in reality, let's dig a little bit deeper, because I saw Jake's eyes getting a little big when you were talking about those funds. Jake's like, hi, I need to put my money somewhere else. And he didn't know about that. He thought he knew the stock market implicitly. He thought
no, I don't. I definitely do not.
But it's interesting. I saw you get really a little interested. You leaned into the mic a little bit. You're like, Michael, keep preaching to me, brother. I like this. I'm only a real estate guy, but this sounds interesting. And that's the reality. That's how life is. I want everybody listening to this, just increase your paradigm a little bit. The conventional wisdom, as we're witnessing over the last 12 months, is not really conventional, and there's very little wisdom in it. And I love the type of platform that you're building, because we've gone down this conventional route over the last 40 to 50 years, and less people are saving for retirement, less people are saving for college, and conventional wisdom is telling you to put it here, here, and here. And Michael's company out there is saying, well, before you do that, come check me out, and I'll allow you to look at our platform and connect with others to be able to educate you on something that hopefully, the conventional wisdom way hasn't worked. Let's check out another way possibly.
Yep. Absolutely. Thanks.
Gino, how much you got under the mattress or in the bird feeder in the backyard?
Bro, I just did a podcast. I used to use a shoebox. That's what I used to use. And I graduated to a safe. And you know what? These days, there's no cash in my life, brother. It's all going into, it's all ACH, and you know what I mean? And
it's all in canola oil futures.
I love it. Guys, appreciate it. As always, we believe in buying deals for the long term. Think in decades. I'm Jake. He is the G Daddy. We make it happen. We'll see you next time.
Thanks, boys.
Thanks, guys.